firstly, really great to have the opportunity to present on Schroder Real Estate Investment Trust. My name is Nick Montgomery, so I am the fund manager of SREIT, as I call it as we go through. SREIT is a main market listed real estate investment trust that owns a really interesting portfolio across the UK. And as we say on the cover here, we have recently evolved our strategy to be even more clear about how, in particular, sustainability initiatives are helping us to drive high levels of income growth. Now, before I do that, I just spend a few slides giving a bit of market context, because we think the UK real estate market in particular is at a really interesting turning point. So you'll have all seen the inflation stats. We're showing them on the left-hand side here. Core inflation is stickier perhaps than we would like, but nonetheless, it does appear that the forecasts are that the CPI will meet the target of 2%, or perhaps ticking up a little bit thereafter. But clearly we have seen, if you like, the worst of the very high levels of inflation. And what that's meant on the right-hand side is the market's expectations for interest rates are that we will see a fall in SONIA, and indeed we are already seeing a fall in 5-year interest rate swaps, which is what real estate investors often use to fix their interest rate exposure. So as a hybrid asset class where you've got the bond-like characteristics through rent, but also the equity characteristics of rental growth, we think the market, again, is at an interesting point. Just to put that in a bit of context, so the chart on the left-hand side here is showing you the trend in property capital value. So this is looking at the underlying asset class. We own direct assets, so we have been exposed to these movements, albeit we've delivered relative outperformance. But you can see here we have seen a very significant correction. Average values for UK commercial real estate are down, around 25% from June 22, the most recent cycle high. And to put that in context, the fall from the GFC period was around 44%. So it is a very, very significant correction. But you can see the lines on the chart there, with the exception of offices, and I'll come back to that. There are signs, for the reasons I just gave, that the market is bottoming out, and we are beginning to see a small uptick in investment activity, which we see as a positive signal, both in relation to the underlying assets themselves, but also corporate activity across listed real estate markets. The right-hand side chart, the grey lines show you the long-run gap between the average yield from property, that's a green line there, and the average yield from property at the moment is about 5.2%, compared with what we call the risk-free rate, so a 10-year bond yield. And long run, the relationship between those two is anywhere between 100 and 200 basis points, depending upon the market's outlook for rental growth. So if you like, the equity component of that real estate total return. And what you can see is we're sort of slightly below the average, taking a long-term view, but with the expectation, as I said at the start, that we will see rates continue to decline. We are expecting, on that very simple measure, for the sector to look fairly valued over the course of this year, which again we think illustrates that we are at that turning point. I think what's really interesting is if you contrast what I said in relation to capital values, so the experience of a GFC where values fell 44%, with what we've seen over the most recent cycle of average decline of around 25%, rents are behaving very, very differently. Now, we often talk about real estate as being a good hedge for inflation, and it's less so on the capital side, but it is a good hedge on the income side. As businesses make more profits, they tend to pay more rent. Obviously, over the most recent period, we've seen a significant increase in build costs. That has allowed developers, where they can, to pass on that in terms of higher rents. And what you're beginning to see is rents behaving very differently to those previous cycles. Now, again, these are nominal rents, so part of it is about inflation. But on the left-hand side, you can see the red line, which shows the rental growth from the most recent correction, so June 22, compared with the period from 2007, the turning point from a GFC, and then obviously the dot-com boom, subsequent bust in the late 80s, early 90s. And for those structural reasons I've mentioned, undersupply, of real estate generally. There's much less development going on. For those of you across the UK, most of the cranes that you'll see in the big cities in the UK are actually residential. But also, particularly on the right-hand side of his chart, in the industrial sector, we still have these very strong tailwinds as arising from those structural changes where more shopping going online still, obviously retailers, third-party logistics operators restructuring their supply chains, leading to demand, but also no one is really building multi-let industrial estates, and that's the part of the market that we've been focusing on, which I will come on to later. So what does that mean? Well, that means that when we look at our forecasts for the sector, and the only certainty about our forecasts is that they are wrong, but they do give an interesting guide, is that we are at that turning point, and we think this year, so calendar 24, we will see a positive return from a sector having had obviously a pretty challenging previous 2 years, and then thereafter, partly because of that attractive income return of around 6%, but also because we are expecting rental growth to continue, particularly in the parts of the market that I've touched on and I'll come back to, a total return for the sector above its long run average of 8% or so. So we are beginning to see more investors looking at the UK and seeing this as an opportunity, particularly compared with other markets where we haven't had such a significant correction. So what is SREI? I'm not going to go through all of this because I know the slides are going to be made available afterwards, but we have a diversified portfolio, a good quality portfolio, 39 assets, over 300 tenants, so again, very granular income. We have a portfolio that's valued at around 460 million. We have a very stable balance sheet, and I'll come back to that in a moment. And we've made a real effort, firstly, to really actively manage the portfolio to drive that higher income with that particular emphasis on developing sustainability performance, but also to weight the portfolio to the more attractive parts of the market. So the top right-hand pie chart you can see there, half of our portfolio is now multi-let industrials. Our retail is very much focused on value retail warehousing and convenience retail, which is where we see the strongest demand across the retail market. And our office exposure, I'll come back to in a moment. Our office exposure actually, almost 10 percentage points of that 25% is actually not used as offices at all. It's used as universities. Now, there's clearly not enough time to give you a full overview of the portfolio, but what we've shown you here are our largest 6 assets. And so these represent, give or take, about half the portfolio value, so around 214 million. And you can see very clearly from the left, great quality multi-let industrial estates. The biggest asset in the portfolio is an asset called Stacey Bush's industrial estate in Milton Keynes. Really good quality asset. We've in fact just completed an operational net zero new warehouse development where we have very good interest, but very granular income, a stone's throw from the A5. Likewise in Leeds, we have one of the largest contiguous multi-let industrial ownerships in Leeds, to the south of the city, very well connected for the motorway network, and in fact, interestingly, close to a very successful office park and a retail shopping centre, and off the back of that demand, there is a new railway station going in, which won't necessarily benefit us immediately, but it will support, we believe, those longer term potential alternative uses. Our offices are, as I say, in many cases not used as offices. So our biggest office exposure is an office used as a university in Bloomsbury, which is one of our preferred submarkets of London, benefiting enormously from, in particular, the Elizabeth line, just a stone's throw up from Tottenham Court Road Station. Really interesting mix of occupational demand. I'll come back to that in a moment. Our second biggest office exposure is City Tower in Manchester. So it's a big lump in Manchester city centre, mix of uses, offices, hotel, university again, as it happens. Lots of opportunities to add value there, working with local stakeholders. Clearly Manchester has captured a huge amount of particularly public sector money into things like the tube, the trams, the BBC, etc. So lots to do there. And finally, on the right-hand side, convenience retail, in particular targeting occupiers like Lidl, Home Bargains, Aldi, and in many cases alternative uses like hotels. Our Premier Inn, for example, in Headingley, where we converted a former office building into a Premier Inn. So good quality portfolio. Key messages, which again I'll end on as well, but these really are the key reasons why we think SREI is interesting today. great quality portfolio, higher yielding portfolio. Our share price today represents a dividend yield of around 8%. Unlike many in our peer group, that is effectively fully covered by earnings. One of the reasons why we again have been confident enough to increase the dividend by about 30% since the onset of the pandemic is in fact not just because of the top line earnings growth, but also because we have a very robust balance sheet. You know, the 75% of our balance sheet debt is locked in at a fixed rate of 2.5%. So again, we think really compelling, and particularly again with that yield reflecting a share price or a discount to NAV of about 29%. Now, briefly, because again, there's really lots to look at on our website relating to this, which I'll encourage you to look at. But one of the things that we've done, because we have real conviction that it will allow us to drive higher income growth, is to seek shareholder approval, which we got strong support for at the end of last year, to evolve our strategy to be even more clear about how sustainability, as part of delivering that operational excellence, will allow us to drive higher income growth. And so we've enhanced the strategy to include that within our investment policy, and alongside that, working very closely with our board, put in place clear governance that allows us to demonstrate to shareholders how we're actually delivering that. And you know, and the key thing we're trying to do here is to extract what we can see increasingly as a green premium. And we are seeing increasingly, not just within the office sector, and of course, you know, almost 3/4 of the FTSE 100 companies have made their own net zero commitments, but more broadly, because it's just good business sense with tenants, there's an increasing focus on tenants wanting to occupy more sustainable, lower cost buildings. And so our asset management approach is even more focused on how we can incorporate these characteristics you can see at the top of the chart here: enhanced health and well-being, improved utility management, to really help occupiers operate those buildings more efficiently, to allow us to drive higher rents. And there is now increasing empirical evidence for that, not just within central London, which is where the data's best, but also outside of central London. That we think will lead to mispricing. Again, I'm conscious of time, so I won't spend too long on this, but I think the key point to note here is, particularly in the office sector, that you know there is, we think, a real opportunity going into 2025 to use our asset management capabilities to buy high yielding offices where we can deliver those building improvements and drive that green premium. Now, slide 17 here gives you an overview of the portfolio. On the left-hand side, we've got the key characteristics. The portfolio is valued quarterly, independently by one of the large independent valuation firms. We actually changed valuer last year in line with, or in fact ahead of best practice. So it's we've had two valuers look at the portfolio over the course of the last 12 months. And I think the key point to note that we're highlighting in blue is that we're granular, 39 assets, over 300 tenants. But really importantly, we have a higher yield profile than the benchmark. So our initial yield, our cash yield, if you like, on rent is 6% compared to the benchmark of just over 5%. And more importantly, our reversion yield, so that reflects the valuer's view on today's market rents, is even higher. So a yield of 8.4% compared with the benchmark 6%. And you can see on the right-hand side there the sector weightings, which again I'll leave with you to look at in a bit more detail at your leisure. Now, obviously, income is key. This is an income-driven strategy, so we do a lot of work underwriting the credit quality of our tenants on acquisition, but obviously as we are then, subsequently monitoring those, and then in fact, partly as a result of the pandemic and the very close contact we had with our occupiers, we have really fantastic rent collection rates. Our rent collection rates, in fact, are higher than they were today ahead of the pandemic, partly because of those relationships. But if you look down the list, you can see the University of Law are our biggest tenant. They're the largest provider of legal services in the UK. Following recent activity, Siemens Mobility, so the global conglomerate, are our second biggest tenants. And as I say, we have two universities in the portfolio. Buckinghamshire University, our second one there, is our fifth largest tenant, soon to be our second again, when a lease restructuring we've done means that they move to their full rent. So granular tenant base, again, partly enhanced through owning lots of multi-let industrial estates. Now, the last few minutes, I'll just give you a little bit of colour on some of those assets. This is a really sort of typical example of the types of deals that we're doing within the team. This is a really interesting example of our brown to green strategy in action. So here we bought an older 1960s, 70s industrial estate, but with a piece of land in South Manchester. We have capabilities within the team here to deliver complex planning applications and then in turn oversee developments. And so what we did with that land is get an enhanced planning consent, create the first operational net zero in use warehouse scheme up in the northwest, and we are in the process of leasing that up at the moment. And so far it's been a great success. If we look at the period since we bought it, once we're fully let, our yield on actual cost will be around 10%, and so far at least since acquisition we've delivered a 20% total return at property level compared with the benchmark at 7%. Another example, I've mentioned this already, but to give you an example of just how diverse the portfolio is, this is the university I mentioned in Bloomsbury. You can see where it's located there. You can see Tottenham Court Road in sort of middle foreground, and where our building is located on Store Street. Really interesting location, lots of different occupiers, financial services, tech, media, and so we have a building here where we've just extended the lease to 2029, but longer term here we think there's a really interesting opportunity to work with the planners to bring forward a longer term redevelopment to capitalize on what we see there in terms of really good occupational demand. We've also got a really interesting pipeline of activity. So I spoke about the difference between our current rent and our values view on market rent. That's about 10 million at the moment, which is in the context of a dividend today at about 16 million. We're just giving you here 3 examples of activity where we can generate potentially about 1 million based on activity that's currently ongoing. From the left-hand side, again, there's more details on these on the website and in our recent accounts, but we've just completed 2 Starbucks pods on 2 of our retail parks, which have generated a really attractive return, long leases to Starbucks with inflation-linked reviews. We've just carried out a very high quality refurbishment of an office in Edinburgh, which is a really undersupplied market, delivered a very high environmental standard, and we're in the process of completing the last phase of leasing activity there to generate another $250,000 of incremental new rent. And finally, another example of how we're using that same sort of approach, delivering very sustainable, good quality warehouse space. And again, one of our industrial assets in Swindon, where we very recently completed that. All of that space is under offer. If we get those deals done, that's another circa $500,000 of net rent. Now, just to finish off, I mentioned earlier on, one of our key strengths, we'd argue, is the strength of our balance sheet. So you can see here, we're giving you a very clear view of our current debt stack. So currently, we have about 175 million of drawn debt. That's a net LTV of around 36.5%. What's most important to note is the dark blue bar there, the Canada Life loan facility, 129 million fixed for 12 years at 2.5%. Now that is fantastic. It's pretty much the lowest cost debt we've seen across the peer group. On top of that, we have what we see more as a tactical facility, a revolving credit facility that runs until 2027. Part of that is hedged with an interest rate cap and collar. Do we have an element of unhedged, but only about 16 million, and we have some sales planned, which we're hoping we will use to repay that. So, alongside that top line earnings growth, if you like, we have really good visibility on, on where our future interest payments are, in contrast with many in the peer group and the wider real estate market who are looking down the barrel at some quite expensive refinancings, given where rates have gone over recent years. So just to conclude, again, we think it's a really interesting time for you to be looking at the UK real estate market. We have corrected ahead, certainly, of other European markets, and obviously that's partly because of the expectation of falling interest rates, but actually also the fundamentals. We have limited new developments and the occupational markets remain relatively resilient. Our portfolio is delivering strong relative outperformance. Absolute returns clearly have been impacted by the correction, but relative to our peers, we're outperforming, and we think we have a really good and interesting pipeline of future activity to help continue driving and we hope dividends. And finally, really importantly, a key part of driving and sustaining that income growth is to be really clear about those sustainability improvements that we're making to our portfolio. because really that's what occupiers want, and that's what we hope will allow us to drive those attractive returns long term. So I'll pause there because I wanted to leave a bit of time for questions if we could, and I'll just put the key points back on the screen. But back to you.
Thank you very much indeed, Nick, and thank you again for stepping in there. First question I had has been around sustainability. Given what you've said on the objectives around sustainability, will you be increasing your office's ownership?
So there are no plans to increase our office exposure immediately. I think we have a program of investments we're making at the moment, which is concentrated on our industrial portfolio. So I think more naturally we will see our industrial weighting continue to drift up. Having said that, I think notwithstanding caution amongst a lot of investors about the office sector, we think there will be some really interesting value next year where we will see some perhaps more distressed owners where they don't have the capability to deliver those sustainability enhancements which will drive value. Now, we will be very selective if we are looking to redeploy into the office sector. We currently are exposed to markets like Bloomsbury, fantastic market, good demand. Manchester in the same way. Prime rents in Manchester have never been as high. So we will do it, but we will look to do it very selectively.
Thank you. And next question says, if the dividend is 90 or 98% covered, sorry, I can't read the writing here, by funds from operations, how safe is the dividend? Is there a possibility it'll have to be cut? And if there's a shortfall, how is that made up?
Great question. So our approach is to only pay a dividend that we believe is sustainable based on the outlook. So as you say, we were 98% covered over the most recent interim period. The reason I gave that number of our reversion, for want of a better expression, so that's the difference between the rent we're currently receiving and the valuer's view of market rents, is because it's never been as high. So that reversion is £10 million of potential income, and that compares with a dividend today of 16 million. Now, we're never going to crystallize all of that 10 million, but that's much higher than our peers. And so it just illustrates that in the context of the current dividend, there is real opportunity if we can deliver those asset management plans to continue seeing earnings growth. And if we do, and if we believe it's sustainable, we will pass that on in terms of an increase in dividends.
And next question has been about discounts. And I think you had, they're not, can you remind us what the discount is? And then the question is asking, how does that compare to your peer group?
Yeah, okay, so just on the slide at the moment, the number 4 there, so we are today at around a 28-29% discount to NAV. We are certainly, up until a few months ago, we were better than the average. I say until a few months ago because there has obviously been various announcements made about M&A activity in the sector. And so we have seen the ratings, relative ratings, move around a little bit. But we are still, I think, better than average. But we hope that if we are really clear about strategy, if we can continue delivering that income growth, but also I think if we do see the catalyst for a re-rating in the sector, because the wider market sort of acknowledges why we think the UK market is well placed today, we would hope to see an improvement in that rating.
The next question is about planning. And how challenging is the UK planning environment with elections looming? Do you see that changing?
So obviously, there is a period of time around elections where the government effectively stops. That doesn't really affect local planning authorities. I mean, as I've given several examples where we have received good planning consents recently. I'd say we are sometimes frustrated by the delays in the planning system, generally, partly because of planning departments being under-resourced, but also the different sort of departments that get drawn in, highways, etc. So it's not a real problem for us, but sometimes, well, we just have to assume it takes slightly longer perhaps than we would like ideally. I guess I'll just add actually final points. I think actually there is an acknowledgement from government, and I'd expect this to continue, that streamlining the planning system should be a good way of trying to improve productivity. One of the things, for example, that Michael Gove announced quite recently was an extension in what are called permitted development rights, where he has essentially removed a cap which applied to where owners of offices could automatically convert to residential. So now essentially a building of any size and building office of any size can be converted to residential. So things like that we are very supportive of. And that will potentially create opportunities and also in some markets reduce the supply of second-hand offices, meaning there is obviously an opportunity for what remains to be improved and drive rents.
Lovely. Nick, thank you very much indeed. Thank you for presenting and joining us this evening.
That's a pleasure. Thank you for the opportunity.